Imagine your portfolio is up 12% this year. You should feel good about that. Then you check someone else's portfolio. They're up 35%. Suddenly, your 12% doesn't feel like success anymore. And that's where one of the most dangerous habits in investing begins, comparing your portfolio to someone else's. The strange thing is, nothing changed about your investment. The companies you own didn't suddenly become worse. Your financial goals didn't change. Your time horizon didn't change. Only one thing changed. You saw somebody else's number. This is the psychology of social comparison. As investors, we naturally want to know how we're doing relative to everyone around us. But investing isn't a race where everybody starts at the same starting line. Think about two investors. One is 30 years old and investing for retirement over the next 30 years. Another is saving for a house in 5 years. The first investor might be comfortable owning a diversified portfolio and accepting market volatility. The second might need more stability because their money has a deadline. Now, imagine the first investor sees someone making huge returns from a few individual stocks. They feel behind. So they sell their diversified investments and start chasing those stocks. That decision might have nothing to do with their original financial plan. It came from comparison. And here's the uncomfortable truth. Someone else's portfolio can outperform yours for years without proving that their strategy is better. Maybe they took more risk. Maybe they invested at a better time. Maybe they were lucky. Or maybe their goals are completely different from yours. So instead of asking, how much did they make, ask a better question. Am I making reasonable progress toward my financial goals at a level of risk I can actually live with? That question changes everything. Your benchmark should not always be another person's portfolio. It should be your own plan. Track whether you're investing consistently. Track whether your savings rate is improving. Track whether your portfolio matches your time horizon and risk tolerance. And most importantly, track whether you can stay invested when the market becomes uncomfortable. Because the best portfolio isn't necessarily the one with the highest return last year. It's the one you can stick with for decades. So the next time you see someone celebrating a massive investment gain, don't immediately ask yourself why you're not doing the same. Ask yourself whether their destination is even the same as yours. Investing isn't about winning someone else's game. It's about quietly building your own. And sometimes the most successful investor in the room is the person who stopped looking sideways and simply stayed focused on the road ahead.